I want to start, actually, if I may, with the environment that we're in and just the supply chain impact, but also the financing impact that you're seeing from the war in Iran. Because, of course, Saudi Arabia and different Saudi entities are your biggest backers. What are you seeing on your desk right now?
Well, so for the moment, I mean, the disruption that we have seen have been rather minimal. So we have not noticed major disruption as far as our supply chain and so forth. We did see some tactical adjustment of some of the logistic costs. The shipping companies have indeed increased some of the pricing. But as far as our operation is concerned, we didn't see any disruption for the time being. So we will need to see long term if the events and the tension are extending for too long, how it will impact the business. But for the moment, I have to say that the disruption is rather minimal.
The big headline for you in the finance org was a timeline or a plan to get to positive free cash flow.
Yes.
I'd kindly ask for a little bit more detail. Mm-hmm. What is the timeline on that? And mechanically, like, what is it? What are the levers you can use to achieve positive free cash flow?
Yeah. So we have two important milestones. The first one is the gross margin positive, and this is expected to happen in the midterm, and you should read midterm basically the next 3 years, and the free cash flow positive is expected by the late decade. So this is the plan that we have. This is the guidance that we have provided yesterday during our investor day. So several levers that we will be activating to get there. First of all, I mean, we are in an industry where scale is important. So scale coming out of mid-size is one of the key catalysts to allow us to go to break-even margin and cash flow positive. So that's the first lever. The second one is the margin improvement and the additional revenue streams that we will be adding to our top line. So the margin is expected to improve on the back, again, of the scale, the various improvements that we're doing, not only in terms of constraining the bill of material or constraining some of the cost lines that we have in the company. It's also about simplifying what we will be bringing to the market going forward. So when you work on a platform with the 95% part commonality over time, this is how you leverage the cost, and this is how you constrain it, and you accelerate the journey towards the gross margin positive. Then there's the additional revenue stream, and I guess that we will be talking about that, the fact of adding software revenue, revenue from business partnerships on Robotaxis. This is an additional catalyst which will accelerate the journey.
So we are so focused right now on the business model for Robotaxi, for all the different conduits of what is a web of partnerships, right? You have announced Project Luna, purpose-built Robotaxi, two-seater. But what I want to understand is, at volume, there's a financing risk and an execution risk from taking the vehicles off the production line and then a fleet operator taking them. So who takes on that burden? Whose balance sheet gets that done?
Well, there are different models, and these models are not meant to be static. So, I mean, speaking about what exists and what we already know. So the first deal that we have done with our partners, with Nuro and Uber, was a deal which was based on the assumption that Lucid provides the technology and the platform and the car. Nuro provides the software and the AI autonomous driving capabilities, and Uber takes on the asset. So this is how we have set up the first iteration of the deal, and we have always said that there will be other iterations, and yesterday the first step has been announced. It's not completely finalized. It will be finalized in the coming weeks, but we have announced what the next step would be, and we can perfectly imagine that things will evolve over time. So the whole question is about the value chain in the ecosystem and how it is split between the different components or partners being involved in this business.
Taoufiq, we're having a finance conversation, which is, you know, it's appropriate. You are the CFO. I wonder, like, how interesting the mechanisms can get. Like, you know, Uber has a financial interest in this, but they have a capital-light model. So do you see maybe private equity or the banks coming in? with some kind of special purpose vehicle, right? They finance that block of volume production until some time where the fleet operator pays you and says, here's the money for all the cars that we're taking from you, because you're not going to operate the service, right? You're not going to operate the fleet. And then, to what extent do you need some revenue guarantees from those other partners?
Yeah. So obviously, I mean, the gold standard in this kind of businesses is to secure recurring revenues. So this is how you spread the risk over time, and this is how you give confidence on the validity of the business case. Having said that, I mean, we are also staying away from whatever is associated with the capital-intensive business. So I don't think that we will ever have a model where we own the assets and we generate revenue out of it. There are companies who do this kind of business very well. Companies, institutions, businesses who are experts in managing assets. So I think that over time, with the growing robotaxi market and the expectation in terms of growth, and you saw the various assumptions in terms of market size, it's really ranging from $300 billion to over $1 trillion, depending on the study you look at. I think that this will create new business models and new operators who will start joining the overall value chain over time.